Hello and welcome to Gould Asset Management's May 3rd webinar. Thank you all for joining us. My name is Scott Smith. I'm a senior portfolio manager and partner here at Gould Asset Management, and I will be helping to facilitate today's talk with Don Gould, our president and chief investment officer. Don is going to be giving us an update on the current state of financial markets and will also be answering questions from you, our viewers. It looks like we have a strong turnout today, and I want to thank everyone for taking time out of their busy schedules to join us. For today's webinar format, Don will take about 30 minutes to walk us through the current economic and market landscape before we turn it over to a time of Q&A. If you'd like to submit a question to Don, you can do so at any time during the webinar. You don't have to wait until the end. We'll be using Zoom's Q&A feature, which you should see at the bottom of your screen. Please post all questions there, as we will not be using the chat functionality to respond to questions. A couple of other quick housekeeping items before we get started. First, we are recording today's webinar, and we will make the replay available shortly after the completion of today's call. So if you have to leave early or you happen to get disconnected, don't worry. You'll still have a way to catch up on anything you might have missed. Finally, we are targeting today's webinar to last approximately 45 minutes, inclusive of the Q&A. And in the event we don't get to answer your question live on air, we will have a member of the Gould team follow up directly with you in the next day or two to make sure we get all of your questions answered. So with all that out of the way and without any further ado, I will turn it over to Don.
Thank you very much, Scott. Good afternoon, everyone. I hope today finds everyone doing well. Let's get right into it. I'm not going to mince words. It's been a tough year so far. And I'm going to kind of show you that in a numerical way right now by sharing my screen and showing you a chart. So hang on one second. All right, so here we have a chart that shows the returns of the US stock and bond markets for all of calendar 2020, all of calendar 2021, and 2022 through April 30th. So what we'll call a year-to-date number. It's almost year-to-date. You can see in 2020, stocks had a tremendous year, 18.4%. Bonds also had a terrific year, 7.5%. Just to put these numbers into perspective, the long-term average for the stock market is in the neighborhood of 10% per year. Bonds, given how low the yields are, you might have expected something more on the order of 2%. So these were really good years. Even better year for stocks in 2021, up nearly 30%. But we saw bonds start to have negative returns in 2021. And then finally, getting back to my opening point here, it's been a tough year so far. The S&P 500 is down about 12.9% year to date, and bonds, this is probably the biggest news of all, bonds are down nearly 10% year to date. So keep this chart in mind as we go through the conversation here. Couple things to add, although it wasn't on the chart, the global stock indices year to date are down about 12.8%, so almost exactly the same as the US stock market. And I think it's an interesting point that international markets haven't done worse than domestic, but about the same. Underneath some of these numbers are some very large declines in some of the highest profile, largest market capitalization stocks. So in the US, for example, Apple is down 10% year to date, Microsoft down 16%, Google, now called Alphabet, down 20%, Amazon down 26%, Facebook, now called Meta Platforms, down 39%, and Netflix, sort of the darling of the streaming technology for home entertainment, down an amazing 68% year to date. So we talk about the FANG stocks, which have kind of led the market and propelled the market over sort of the 13-year bull market that we've had since early 2009. Here you see the leaders of that group really having a difficult time this year. As I mentioned, bonds are down 9.5% year to date. It's very unusual to see a decline of both stocks and bonds of this degree at the same time. And I think that's what makes this an unusually tough year. I think stock investors understand that we will have corrections from time to time. We will have bear markets from time to time. We'll have volatility. But we expect our bonds to provide a cushion, and they haven't done that so far this year. Last time we saw this kind of movement of stocks and bonds downward together was in the 70s. And again, there we had inflation as one of the primary causes. So let's just say it. It's darn unpleasant to open your statement and see pretty much everything down, but that's what it's been like so far this year. At the end of my talk, I'm going to talk about how to keep this kind of period or episode in perspective. But let's first get into what are some of the main factors behind the decline in stocks and bonds this year. I'm going to come back to a topic that probably nobody wants to talk about anymore, but we can't avoid it, and that's the pandemic. I think at the heart of what we are seeing this year is the pandemic and what I'm calling the boomerang effect. The boomerang of first the stimulus to try to avoid economic calamity in the early stages of the pandemic, and then the monetary tightening that we're now experiencing now. The other aspect of the pandemic, which is still with us, is not just case counts, but for example, in China, where we see such high case counts that there are major lockdowns in Shanghai and Beijing, which have a very direct impact on the global economy. So the pandemic is a big part of this story. The other parts of the story, and I'll come to each of these one at a time, but just to lay it out for you at the beginning, in addition to the pandemic and related to the pandemic, are inflation, higher interest rates, economic slowing, potentially, now a war in Europe, and finally, psychology. So let's tackle these one at a time. I'm going to start with inflation. So let me share my screen again. All right, just trying to get to, no, it's not wanting to go to the next page. Hold on. Okay, here we go. Bear with me. Well, we practiced this. All right, here we go. Okay, try again. All right. So here what we have, actually, I want to go to this chart. We have monthly inflation going back all the way to pre-pandemic. So you can see we kind of came into the pandemic at in the sort of 2 to 3% area, which is kind of where we've been for a long time and not far from the Federal Reserve's target. And then you can see the pandemic hit and inflation went right down to zero. And at this point, Federal Reserve is very worried about potential deflation. Deflation's got all kinds of problems associated with it. And so this is the point at which the Federal Reserve starts stimulating in a huge way. And now we see inflation gradually rising. And then with, I think, maybe the advent of the vaccines and other things, you see it accelerating here and then even further here. Now, to put this in a long-term perspective, you can see this is going all the way back to 1972. So the 1970s were a period of very high inflation, double-digit inflation for a significant portion of that decade. And it wasn't until Fed Chairman Volcker jacked up interest rates to almost unimaginable levels that the inflationary psychology was removed from the economy. But you can see that since then, it's been a period of sort of 0 to 5% inflation, a brief bit of deflation during the great financial crisis in 07 to 09. And then suddenly this spike here. So that gives you an idea of where inflation is. This is the highest level that we've seen in about 40 years, and it's very concerning. So where did this inflation come from? You know, I look at this inflation as the backside of the pandemic boomerang. And what do I mean by the boomerang? Well, we start by tossing the boomerang out, and that comes in the form of this massive government stimulus. In the United States alone, it's estimated that the government stimulus was on the order of $5 trillion, which is a staggering number. That's 1/4 of our annual GDP. Now, the United States runs a budget deficit to begin with, pre-pandemic. So $5 trillion in additional government spending means $5 trillion in additional borrowing. The Federal Reserve accounted for about 3 trillion of that 5, in that they actually went out and in effect bought $3 trillion worth of the government bonds that had to be issued to pay for this $5 trillion. That's what's known as monetizing debt. Some people simply call it printing money. The effect of all this stimulus was to stimulate demand and to make sure that the pandemic didn't allow us to fall into a deep recession or even a depression. Now, at the same time, we had supply problems, which is that the pandemic caused huge numbers of people to leave the labor force, either because they were laid off or because they had to stay home and take care of children, or any number of reasons, fear of getting sick, and so on. We also had supply problems. For example, chip factories in Asia were unable to operate, and chips are so essential to so many things that are made now. So this created supply problems. We had supply chain problems, delivery problems, cargo ships backed up as far as the eye can see off the ports of Los Angeles and Long Beach. So when you think about inflation, it's always the interaction of demand and supply. We had demand being juiced up tremendously by the stimulus. We had supply problems that were also outgrowths of the pandemic. You put the two of those things together and you get this price spike. Now, people will criticize the government for having overstimulated the economy, but let's face it, it was the first pandemic in 100 years. These things are very difficult to calibrate. The measures that were passed were passed very hurriedly, and not with perhaps as much thought as we would like when we're implementing programs of that magnitude. So now what the Fed is trying to do is have that boomerang come back and catch it and not have it sort of chop the head off. The Fed doesn't want this high inflation rate to get ingrained into people's expectations. They want to be able to slow the demand side of the economy. The Fed really doesn't have much control over the supply problems, but by raising interest rates, which is what they have been doing and what they are going to continue to do, the effort is to try to slow the demand side of the economy. And in doing that, to slow down price increases and to change in, consumer expectations about what inflation will be in the future. When inflation expectations get too ingrained in people's heads, then people start building it in as an assumption. And so you get kind of a spiral where expectations of inflation become self-fulfilling and result in more inflation. The balancing act that the Fed has to carry out here is that while trying to slow the economy down, they don't want to throw it into recession. The so-called soft landing is where you slow the economy down, you reduce those inflation expectations, and yet the economy, even though it's growing more slowly, it's still growing. It's not going into recession. It's an art and not a science. We're all hoping they can engineer a soft landing, but we'll have to see. So let's take a look now at just what the Fed has been doing on interest rates. It's been quite remarkable, actually, what's happened just in this year alone. All right, so if you look at this chart of interest rates, this is just January through April of 2022. We have three different interest rates. So the blue one here is the interest rate on the 3-year Treasury, 3-month Treasury bill. You can see it started the year very close to zero, where it had been for several years. And by today, it's already approaching 1%. You look at the 2-year Treasury, it started at 0.75. I might add that if you went a little further back in the past on this chart, it wasn't much above the 3-month. But it started at 0.75, and now it's well over 2%. That's a remarkable increase in just 4 months. And finally, the 10-year Treasury yield started the year a little above 1.5, is now been bumping up against the 3% mark. So, this is really quite remarkable. All right, so let's go back. Now, the Fed actually has only raised its short-term interest rate, the Fed funds rate, by 0.25%, but it is telegraphed that it is going to raise them more. In fact, tomorrow will be another raise. Most people believe that that will be a 0.5% raise. So that would make a cumulative 0.75%. But the markets believe at this moment in time that the Fed will probably raise short-term interest rates in this calendar year all the way to about 3%. And that's a huge change in a very short period of time. So again, by raising the cost of borrowing, the Fed is seeking to slow the economy, reduce demand, and thereby slow inflation. Okay, next thing I want to touch on is the war in Ukraine. Clearly, it's a humanitarian catastrophe. And we could talk for a long time about that, but obviously the focus today is on the implications for economies and markets. The first thing that we've all seen is that since the beginning of this war, we've had higher energy prices. And that's because a portion of Russian energy supply has been taken off the market, in part because many of the developed countries in the world are refusing to either use Russian energy or are dramatically cutting back their consumption of Russian energy, oil and gas. Second point that we're seeing is certainly higher food prices. Ukraine is one of the world's bread baskets. It's one of the largest producers of grains. And this year's grain harvest may be completely lost because of the conflict. So we're seeing higher food prices. In Europe in particular, we're seeing massively higher energy prices. And I want to just show you a couple charts to give you some idea on this. So here you have residential energy and distribution prices in the EU. And you'll see here that the axis is starting at 100 back in mid-2015. Price of electricity is now at an index of 187. And you can see virtually all of that rise has come since the beginning of 2021, but a huge steepening of that since the beginning of the war in Ukraine. So it's almost doubled. And natural gas, which is the primary source of home heating in Western Europe, has more than doubled. Here's another chart, which just shows you UK energy price increase. A new bill was passed in the UK, and that one bill allows an increase of 54%. And you can see that the 2,200 pounds per year heating bill. So, the reason I show you these charts is to think about, well, what is one of the impacts of this war on the global economy? When energy prices go up so sharply, so quickly, we've seen it at the pump in California where we're paying $6 a gallon for gasoline. It's like a tax. It's like a tax increase because people's incomes don't change overnight. And so what happens is when you have to allocate a lot more of your budget to energy, because energy is not something that in the very short run you can greatly reduce your consumption of. It's what's called inelastic demand. And so you have to reallocate a larger portion of your budget toward energy prices, which means you have less money to spend on everything else. And so that tends to dampen economic growth. And so it's kind of interesting because the war, in one sense, is both inflationary, right? We see energy and food prices going up, but at the same time, it's also deflationary because in general, what it's done is it's reduced people's real purchasing power by making the cost of certain key commodities higher. The other thing we have to acknowledge about the war is that it raises general uncertainty. And markets always, in effect, place a higher discount rate when there is more uncertainty in the world. We don't know how this war is going to play out. And because we don't know, and because this is an element of uncertainty that we weren't dealing with 6 months ago, you can also see that in the form of, possibly in the form of lower stock prices. The pandemic in China, as I mentioned, there are major lockdowns in Shanghai and Beijing. These result in major disruptions in one of the world's two largest economies. So the ripple effects of this are huge, and again, tend to depress global economic output. In this sense, you could argue that the war and the pandemic in China actually move things in the same direction that the Fed is trying to move things with higher interest rates. Some people are afraid that the Fed will overdo it on the interest rates, not recognizing that there are already deflationary forces at work in the form of this war and also the effects of China's pandemic. Now, the question then comes to, are we going to have a recession? And, you know, nobody knows the answer to that. Our feeling is that the odds of a recession in the next 2 years are probably meaningfully less than 50%, but we're just guessing. We don't know. The US economy actually contracted in the first quarter, and some people are pointing to that and saying, well, that's evidence that, you know, recession is around the corner. But you have to also recognize that our GDP growth last year was in the 5 to 6% range, which is way, way above sort of the 2% per year rate that most people feel is sustainable over the long term. So again, it's that boomerang. We had an unusually strong year last year with economic growth, and now, you know, we're under the trend line. But I think the two of those are connected. And then the final item I wanted to talk about was psychology. You know, when markets go down, and when they go down for a long enough period of time, the sentiment or the psychology of the markets can change, and you know, not surprisingly, do change and move toward a perhaps more pessimistic outlook. And so the point I'm trying to make is that market psychology can feed on itself. I want to share another chart with you here. So this is a volatility index based on the S&P 500. That's called the VIX. This index is derived from the price of options. And the way you can think about this index is it sort of reflects the price of buying an insurance policy on the stock market. The more fearful people are about the stock market going down in the near term, the more they will pay for insurance. So you can see here that particularly as we get into you know, the fourth quarter of 21 and the first quarter of 22, that the trend here is clearly towards a rising degree of fear, which you might consider maybe synonymous with pessimism. We're not anywhere near the levels that we reached at the early stages, the most acute moments of the pandemic back in February and March of 2020, but still clearly a trend here. So, we look at interest rates right now, we look at stock prices, and honestly, we don't think that either of them are particularly out of whack, that both probably are reasonable representations of where the economy is. But that doesn't mean that markets can't overshoot, and that's where psychology becomes important. If pessimism feeds on itself, ultimately markets can go down below what we would consider to be a reasonable price for what the future prospects are. And just to give you the flip side of that, that phenomenon, somewhere around the end of 2020 and early 2021, we reached a period of what I would call peak giddiness, where you saw everybody wanting to be in crypto, where you saw stocks like GameStop, going up, 2,000-3,000% on no fundamental basis at all. And I think now what we've swung to is a period of some pessimism, which is also affected by the news that we read every day. We may not be at a moment of maximum pessimism, which is often where markets reach bottom. We just don't know. But I just want to emphasize the importance of psychology and the uncertainty that it adds to any kind of forecast about where the markets are going. Bottom line, the stock market certainly could go lower from here, but that's not a prediction. It's just that we never know until after the fact when we've reached a bottom, when we've reached a moment of maximum pessimism, and when the pessimism finally exhausts itself. All right, so let's talk some good news. It is natural, it is human nature, and the behavioral economists talk about this a lot. It is natural to anchor our thinking to the high water mark on our portfolio, but I would assert that it's not healthy. And I would ask you to consider a different anchor. And so I'm going to go back to a chart. Give me a second here. There we go. This is a chart of the S&P 500 from the beginning of 2020, so just before the pandemic, up to present day. Now, at this point here in February of 2020 represented an all-time high for the S&P 500. And we had a remarkably quick 34% decline over a period of maybe 5 weeks in February and March. And then an absolutely unbelievable 118% rise from this low point over a period of what? About 21 months. Now, just to put that in perspective, the market averages, going back to 1926, about 10% per year. So we had the equivalent of maybe 10 years of average market appreciation in 1 3/4 years. Just really astounding. So people tend to anchor to this point here, which was right around New Year's Day. And if we go out to here, as we saw before, we're down about 13% from that peak. But I would suggest you consider this to be another potential anchor. And I would put the following thought experiment forward. If we had been sitting here at February 1, 2020, and I told you that we were about to have a once in a century pandemic that would still be going more than 2 years later, that we were going to have our first ground war in Europe since 1945, that we were going to have all kinds of political turbulence, and who knows what else I'm leaving out about all the things that happened over the last 2 years. If I told you all that at this point in time, and I told you further that on this May 3rd of 2022, that your S&P 500 would be up about 22% from this high water mark, you might not believe it, but in all likelihood, you'd be pleasantly surprised. So when I come back to this whole boomerang concept, you know, we had this first phase of the boomerang where the economy's falling off a cliff. The government stimulates like crazy. A lot of that money ends up in financial assets. It ultimately starts bleeding into the real economy in the form of excess demand that manifests itself in inflation. And the Fed, after pushing its pedal to the metal, is now slamming on the brakes. And so government was giveth and the government was taketh, right? And so this is kind of the way I try to think about this and to try to put it all in perspective. This was not a sustainable rise. But if we look at the longer term trend, the fact is that over this 2-year period, now it's been a little more than 2 years, averaged about 10% per year on the S&P 500, despite this massive boomerang. So other good news, the way I think about it. We think that valuations in the stock market are actually about right. That doesn't mean the market can't go down from here. Things can become undervalued, but when we look at valuations and we calibrate them to the level of real, that is inflation adjusted interest rates, we think that stock market valuations are certainly within a range of reasonableness right now. We also think there's a good chance that inflation has peaked. Markets are forecasting about a 4.8% inflation rate for the next 12 months, which is significantly down from the roughly 7 or 8% that we've seen over the last 12 months. For the 12 months after that, they're forecasting 3.5%. And for the 12 months, 3 years out, the third year out, are forecasting under 3%. So starting to move back towards sort of the 2% long-term target that the Fed has. I want to show one more chart here. So this is the 10-year Treasury yield. And this is the big spike that we've had in yields, which has caused bond prices to go down. But again, put it in perspective. Going back to 2007, this number here, you could argue is, you know, not far from the middle of the range of this period. So again, if all you're anchoring from is these all-time lows that we hit early in the pandemic, or even where we were at the start of 2022, then yes, this is a frightening increase, and you've seen it in the reduction in your bond prices. But the fact is that most of this period, interest rates were going down. That was a tailwind for bond prices. We've given some of it back. It's again the boomerang. Other good news. So we think there is a good chance that bond prices will stabilize near the levels that we're at right now. We think there's reasonable value in bonds at the moment. And if they do, then they will again perform their traditional risk reduction function in portfolios. Other good news, as short-term interest rates rise, and as you've seen, they've already risen dramatically, you will soon be able to earn something on cash after many years of basically suffering with zero interest rates on cash. So that's good news for savers. And finally, higher interest rates are good news for the bond portion of your portfolio. In our quarterly letter that we sent out to clients recently, we talked about this idea of someone driving from the West Coast to the East Coast, and they calculate that they're going to need to fill up their gas tank 6 times to get from one coast to the other. So on Sunday night, they fill up their tank and it costs them $100. And the next morning, gasoline prices, for whatever reason, drop by half. Well, the bad news is that your tank of gas is now worth $50 and you paid $100 for it. So you might feel a little chagrined that maybe you should have waited. But the good news is that your next 5 tanks of gas are each also going to cost $50. 250 total. So initially you thought it was going to cost you $600 to drive cross country in terms of gasoline, and now it's going to cost you 100 plus 250, which is 350. So you just saved $250. The same holds for bond investors whose time horizon is longer than the maturity of their portfolio. And that honestly describes almost all of our clients. Because what happens is that you refuel your bond portfolio at these higher yields over time. And so while the immediate effect is that your gas tank full of bonds just fell in price, and that's what you saw in that minus 9.5% return, as you refill your bond portfolio, reinvesting the interest and the principal as bonds mature, you're going to be doing so at much more attractive yields. Okay, finally, a little bit of philosophy. The number at the top of your monthly statement can easily feel like an abstraction, a little bit like a black box that spits out a new number every month without rhyme or reason. And it can seem arbitrary, these fluctuations from month to month. And to a degree, it is arbitrary. The price the market puts on your portfolio at any moment in time can change for no other reason than that the moods of the investing public have changed. But in the long run, that number is not arbitrary. Remember, your portfolio is a collection of investments in the equity and debt of real companies, real businesses that are working round the clock, year round, to sell their product or their service to generate revenue. That work is what gives your stocks and bonds value. It's not a black box. The revenue that these companies generate is what pays the principal and interest on your bond portfolio. The profits from the business are what give your stocks value. Individual businesses' fortunes will wax and wane, but in the aggregate, business grows with the economy. Corporate profits grow with business, and a diversified portfolio will participate in that growth. Most people don't question the intrinsic value of their home when the price of their home declines. And that's because you live there and you appreciate its value every day. If you were visiting daily each of the hundreds or even thousands of real businesses that are represented in your portfolio would feel as tangible to you as your home does. Today's challenges are temporary. They will pass. Inflation will subside. The war will eventually end. In the meantime, economies will adapt to the dislocations. The pandemic will eventually burn itself out. The economy will likely slow, and that's the intention of the Federal Reserve. It might even go into recession, but if it does, from there, it will almost certainly recover as it always has in the past. And finally, today's worries will be replaced by a whole new set of worries. I'm going to show you one last chart, and then take a couple questions. This is a chart of the growth of $1 invested in different things from 1926 through the end of 2021, so just 4 months ago. If you had put, and you can multiply all these numbers by 1,000, and I think it makes them more interesting. If you had put $1,000 into treasury bills in 1926, it would be worth $22,000 now. If you put $1,000 into long-term government bonds, and we're now talking, what, 96 years ago, it would have grown to $175,000. If you'd put $1,000 into large cap US stocks, it would be worth $14 million. Okay. This is a logarithmic chart. Now, you look at this path of getting here, and believe me, there are these little downturns here. They're not so little at the time. These are absolutely terrifying. And that's why most clients have a balance between stocks and bonds, because these downturns are just too great in percentage terms in the short run for people to stay the course otherwise. But I think the point here is that investors have been very well rewarded for staying the course. We don't see any reason why, if we were to extrapolate this chart, that any of these lines would not continue to be going upward in their slope. Of course, the slope itself might be different. Future might have higher returns or lower returns than the past. We don't know that, but we do believe that investors will be rewarded for their patience. Okay. Well, finally, just as we always say, if these rocky markets are causing you anxiety, please give us a call. We'll talk it through with you. That's why we're here. And now let's take some questions.
Great. Thanks, Don. Really helpful kind of putting things in perspective. There's so much going on in the world right now that, yeah, it feels a little crazy. And that was really helpful to take kind of a step back and look at the long-term picture. As we move into our time for Q&A, just a reminder, if you have any questions that you'd like to pose to Don live, please use that Q&A feature at the bottom, probably of your screen on your computer, or I think it's also available if you're watching via cell phone or tablet. Just go ahead and click on that and type your question in there. We did have a few questions who were emailed that were emailed in advance of the webinar, so we can start with those as we see if any live questions start to come in. So first off, Don, we got a question about bonds, and given that bonds have really struggled this year and have dropped significantly, someone was asking whether they still make sense as part of a balanced portfolio.
Yeah, it's an understandable question. Bonds have not cushioned portfolios in 2022 the way we would expect or hope. And we talked about why that is. It's, the interest rates moving up. However, we think most of the bad news in the bond market is probably behind us. But whether that's correct or not, our answer to the question would be an emphatic yes. Bonds do belong in a balanced portfolio today. If you look historically, you will see that in the vast majority of time periods that you pick historically, bonds do diminish overall portfolio volatility. The first quarter was the exceedingly rare quarter where they didn't, but that does not in any way change our longer term view on that.
Another question, with the situation and war in Ukraine, do we think international stocks are still a prudent investment?
Yeah, another, perfectly logical question. You see missiles being lobbed in both directions, not all that far from the border with Western Europe, and it's concerning. But our view would be that international diversification makes as much sense now as it ever did. Remember that markets are by and large efficient. Prices are adjusted to reflect whatever new risks the war may be posing to European businesses. But as I mentioned at the outset of this, interestingly, international stock markets have basically matched US stock markets this year, despite this war. So again, you have to look beyond what we think of as the short term or the transitory, and I hope and pray that this war falls into that category, and look to your longer term game plan. And for almost all our clients, that does include international stock diversification.
Next question is about Bitcoin, Don. One of our clients is wondering what impact you think having maybe some Bitcoin in your portfolio, what impact that might have on your portfolio volatility. Might it help? Would it hurt?
Well, if you simply went out and bought Bitcoin, it would almost certainly increase your portfolio volatility for two reasons. One, the asset itself has been very volatile. more so than the stock market. That's number one. But number two, it's been highly correlated with the stock market. Now, if Bitcoin had been going up when the market was going down and vice versa, you could make an argument that it might actually stabilize your returns. But in fact, I would say, based on recent history, Bitcoin would only accentuate the volatility in your portfolio. Now, that's a separate question as to whether Bitcoin is a good idea. That's probably a topic for another webinar. We don't invest our clients' assets in cryptocurrencies. We're not making a political statement there. We're really just, as fiduciaries, we don't feel we can invest client assets, client money into assets where we really truly have no idea how to arrive at a valuation for that asset. We've told clients who are interested in crypto that, we may be able to facilitate their investment, but it would be on a non-discretionary basis, meaning it's their decision, not ours, both to buy and to sell. Or of course, they could simply go to any of the number of companies who are very prominently advertising, as we saw in the Super Bowl, that will get you into crypto. And all I can say is buyer beware.
Fair enough. Next question is about potential for recession. If a recession were to happen, we have a client who's wondering what might someone, do, I assume to maybe protect their portfolio.
Okay. Well, again, if you have a balanced portfolio, and we just play this out, and let's say that we have a recession where the economy actually shrinks for some period of time, one would expect that that would have a negative impact on corporate earnings. That wouldn't be good for the stock market, but it also, in all likelihood, would cause interest rates to move in the opposite direction of where they've been moving, which is to say they'd be going down. And one could expect that bonds would, remember, when interest rates go down, the price of existing bonds goes up. And so you would expect that the bond portion of your portfolio would provide some cushion, some inverse correlation with stocks. But again, I think our core advice would be that your time horizon is vastly longer than however long this next recession might last. You have to ride it out, is what we would say. Now, some people would say, well, if recession's coming, maybe we can sidestep it, get out of stocks, keep our bonds. This assumes that somehow we know more about the future than all of the aggregate of market participants at the moment. And we don't. And we've never seen anyone who can successfully time markets. The one thing we do know is that when you bail out of stocks, if it's in a taxable account, you will almost certainly pay a lot of capital gains tax. And I will tell you also that neither you nor we will know when the bottom in the market has been reached. But generally, people who get out of stocks in an effort to sidestep a decline almost never get back into the stocks at a level below what they sold. They may get out before the bottom, but they won't get back in at the bottom. They'll get back somewhere on the way back up, and usually at a higher level than where they got out.
That's great. And I think it's important to remember that the stock market, is not the economy, and the economy is not the stock market. Just because, even if you knew we were going into an economic recession, yes, in the long run, the market, is tied to, in some extent, economic growth. But in the short run, not always. I mean, lately, we've actually been seeing situations where bad economic news has been good for the markets because it's, suggested maybe the Fed will take a slower route in raising rates. So it's difficult to, extrapolate and know exactly what impact, economic conditions are going to have on markets. Yeah, like Todd said.
Old saying, buy on the rumor, sell on the news. So if markets see a recession ahead, they will, in that moment, adjust stock prices down to reflect that expectation. When the recession actually arrives, it's old news as far as the market's concerned. That might be the point at which the market moves up. So again, it's, we try to keep the long term in mind, and trust that we will be rewarded if we stay the course.
Don, we've gone already a little over our 45-minute allotted time. So we do have a couple questions that I see here we didn't get to. We'll be sure to follow up directly with those clients to make sure we get them answered for you. Just want to, thank everyone for being in attendance today. We'll be doing more of these throughout the year. If you have ideas or topics you'd like us to cover, please don't hesitate to reach out, drop us an email, and we'd love to do more of these going forward. Anything else, Don?
No, just stay safe. Thanks very much.
Thanks, everyone.